Welcome to Live Economic News, your go-to source for live economic updates from around the world. I'm thrilled to have you with us today. In today's discussion, we're diving deep into a pressing issue that's impacting nations far and wide. The Malaysian and Thai economies are currently facing a significant challenge as their currencies experience a downward slide against the mighty dollar. It's a topic that affects us all, whether you're an investor, a business owner, or simply someone keen on understanding the global economic landscape. But before we delve into the details, I want to invite you to be a part of our growing community. If you find value in staying informed about crucial economic developments, do us a favor. Hit that like button to show your support and subscribe to our channel for more insightful updates. Your support motivates us to continue bringing you real-time news and analysis. Hold on to your hats, folks, because in the heart of Southeast Asia, currencies are currently on a wild ride, nearing their annual lows in the face of the unstoppable force that is the American dollar. Picture this: the Malaysian ringgit and Thai baht, once standing tall, now leading the charge in this downward spiral, causing governments and businesses across the region to hold their collective breath. Why, you asked? Well, it's a tale of worry, an anxiety-inducing narrative about the economic consequences that come hand in hand with this alarming depreciation. As the digits on currency charts shrink, a shadow of concern looms large. The once mighty purchasing power of these currencies now feels the strain as import costs soar, leaving many sectors in a financial pinch. But here's the twist: while the local wallets feel the weight, regional exporters find themselves caught in a peculiar predicament. Despite the currency's freefall, the opportunity to capitalize remains elusive. Why? Uncertainties grip the major markets, with China, a colossal player in the economic arena, shrouded in question marks. In this precarious dance between currencies, importers grapple with mounting expenses, and exporters find themselves treading cautiously amidst unpredictable global landscapes. It's a story of balance, a tightrope walk between financial stability and the unknown. In the intricate web of global economics, the story of currencies is often a thrilling yet perilous tale.
If this inflation print this week is on the higher end, and if they do have one more left, I mean, is that it?
Currently, Southeast Asia finds itself at the center of this narrative, where the value of currencies like the Malaysian ringgit and Thai baht is dancing to the unpredictable tunes of the surging American dollar. This dance, however, is not without its risks and rewards. Traditionally, a weaker currency spells good news for exporters and the tourism industry, opening doors to new markets and enthusiastic travelers. Yet, beneath the surface of these apparent advantages, a deeper complexity unfolds. A sustained dip in currency value has the potential to set off alarm bells, possibly leading to capital outflows, a scenario that economic experts view with concern.
A quick look at the markets now. Asian stocks rose at open after a sharp beatdown in the global equities and bucking the pessimistic signals from the US stocks after the Treasury yield surge.
Adding to this intricate mix is the recent surge in oil prices, a development that paradoxically raises fears of faster inflation. Imagine it as a delicate balance. A slight nudge in one direction could tip the scales dramatically.
Looks like US is keen to expand the controls that it announced end of last year because there were some loopholes.
Charu Chinana, the astute market strategist at Saxo Markets in Singapore, succinctly describes the situation as a dangerous cocktail for the economies of the ASEAN region. It's a phrase that encapsulates the precarious nature of the current economic landscape, where factors like a strong dollar, a weakened Chinese economy, and soaring oil prices intermingle, creating a potent blend of challenges and opportunities. In the bustling landscape of Southeast Asia, currencies are putting on a dramatic show, and the stars of this spectacle are the ringgit and baht, both facing a tough battle against the mighty dollar. As the year rolls on, these currencies have slipped, with the ringgit falling by 6.9% and the baht by 4.4% by October 13. The Vietnamese dong followed suit, dropping by 3.4%, while Singapore's dollar and Indonesia's rupiah managed to hold their ground, albeit with minor slips of 2.1% and 0.7% respectively. Now, why is this happening? Well, it's all connected to the robust economic growth in the US. The US economy is thriving, with strong economic and wage growth, which has pushed up Treasury yields and the value of the dollar. This success story across the Pacific has led investors to believe that the Federal Reserve, the U.S. central bank will maintain higher interest rates for a longer time to tackle inflation. So, what's the ripple effect of these high U.S. interest rates? They act like magnets, drawing in investors seeking better returns. This, in turn, prompts capital to flow out of Southeast Asia, putting pressure on regional currencies. Just recently, the Malaysian ringgit hit a low point, reaching 4,729 against the dollar on October 4. In the vibrant tapestry of global finance, Malaysia's currency, the ringgit, is currently weaving a complex tale, influenced by economic nuances and international ties. Picture this: against the backdrop of a widening interest rate gap with the U.S., the ringgit finds itself caught in a subtle yet powerful dance of numbers and decisions. Malaysia's central bank, amidst a backdrop of moderate inflation at 2% in August, has cautiously tightened its policies, raising the benchmark rate just once this year, in May, to 3%. Meanwhile, across the oceans, the Federal Reserve in the U.S. has taken a more assertive stance, lifting its overnight rate substantially higher, fluctuating between 5.25 and 5.5%. This stark contrast in policy decisions has become a defining rhythm in the ringgit's dance. But that's not all. The ringgit's movements are not just a solo act. They are intricately entwined with the fate of the Chinese yuan. As China's economic growth experiences unexpected lulls, Malaysia, deeply connected to the Chinese economy, sways in harmony with the yuan's fluctuations. Intin Nadia Jalil from CIMB Group aptly describes it: the ringgit moves in lockstep with the Chinese yuan, a testament to the interconnectedness of the global financial stage. In the ever-evolving landscape of global trade, Malaysia's Prime Minister and Finance Minister, Anwar Ibrahim, has set forth a bold vision. Picture this: on a significant day, October 10, he stood before the parliament, announcing ambitious plans to reshape Malaysia's economic destiny. How? By exploring innovative pathways to trade in local currencies, a move aimed at loosening the grip of the dollar on Malaysia's trade and investment endeavors. Anwar's words resonated with determination. He revealed that Malaysia was actively venturing into initiatives to reduce reliance on the U.S. dollar. While completely severing ties with the dollar might prove challenging, Malaysia is gearing up for a proactive and assertive approach to utilizing its currency, the ringgit, in international transactions. It's a transformative step, one that promises resilience and independence in the face of global economic shifts. The groundwork for this change is already being laid. Malaysia has initiated transactions using local currencies in dealings with key partners such as Indonesia, Thailand, and China. This strategic move not only fosters stronger regional ties, but also paves the way for a future where the ringgit plays a central role in Malaysia's economic interactions on the world stage. In Malaysia and neighboring Thailand, concerns are mounting over the swift rise of the U.S. dollar. Thailand, in particular, witnessed its local currency, the baht, hitting a 10-month low against the dollar on October 3, sparking worry among investors and exporters. Analysts point to a lack of confidence in Thailand's economy, exacerbated by the government's digital money initiatives that could lead to substantial public debt. This economic uncertainty has resulted in a weaker and highly volatile baht, making exporters hesitant to set prices, fearing potential losses due to exchange rate fluctuations. Similarly, in Indonesia, although a weaker currency typically benefits exports, a declining trade surplus has diminished support for the rupiah. As these currency concerns ripple through the region, stabilizing efforts are being urged to support local economies. In August, Indonesia reported a trade surplus of $3.12 billion, but this positive news is overshadowed by a 21% drop in exports, falling to $22 billion compared to the previous year. This decline is attributed to reduced commodity prices and weakened demand from China. Meanwhile, the Philippines Central Bank, under Governor Eli Remolona, maintains a firm stance on the depreciating peso, viewing it as beneficial due to increased remittances from overseas workers. However, this depreciation substantially raises costs for importers, particularly for energy and production inputs. In Vietnam, a major player in the region's import-export market, the impact is significant, especially as manufacturers gear up for the upcoming Christmas season, heightening concerns about rising costs during this crucial period. Regarding the economic landscape, Richard Bullock, a senior research analyst at Newton Investment Management, believes that the current currency declines in the region are manageable. He points out that the balance of payments remains robust, and foreign exchange reserves are substantial enough to cushion short-term capital outflows, providing stability. However, there's a potential challenge on the horizon. The rise in oil prices, triggered by supply cuts from major oil-producing countries like Saudi Arabia and Russia, could pose a threat to regional economies. Brent crude, for instance, recently exceeded $90 a barrel for the first time since November 2022. Morgan Stanley, in a research note, anticipates oil prices staying above $90 a barrel until mid-2024. This situation, coupled with lower inflation rates in Asia compared to the US and Europe, raises concerns. The investment bank cautions that higher oil prices might significantly impact the region's inflation levels. There's also a possibility of Asian central banks adopting a more cautious approach if inflation exceeds market expectations in 2024, according to the note. Stay informed and navigate wisely through these economic shifts. Before we sign off, let's ponder on a thought-provoking question. In light of the recent challenges faced by Asian economies, how do you think these shifts in currencies and oil prices might impact the global economic landscape in the coming years? We value your thoughts and look forward to hearing your perspectives in the comments section below. Thank you for joining us today on Live Economic News, your trusted source for real-time insights into the world of global economics. If you found our discussion enlightening and valuable, don't forget to show your support by hitting the like button and subscribing to our channel. Your support keeps us motivated to bring you the latest updates on economic trends, market analyses, and insightful commentary.